Well, let's get on over to Yahoo Finance's Brian Sozzi. He's sitting down in Tampa, Florida for an exclusive interview with DoubleLine's Deputy CIO. Soz, take it away.
All right, thanks so much, Julie. Jeff Sherman, good to see you as always. The first investor meeting in this new Tampa headquarters, right?
That's correct. Yeah, welcome. Let me be the first to welcome.
Well, hopefully not the last one, of course, too. It looks like a packed room. So this is really the first turbulent patch for the markets this year. January was okay. We're seeing things really under pressure here. What is causing it, and how much pressure you think is likely to come here in markets?
Well, what we've seen is last year was one that was characterized by the inflation narrative. Obviously, one of the fastest hiking regimes of the Federal Reserve in the last 4 decades or so. And the year started off as just a reversal of everything. And the markets were so pessimistic last year. You got this little bit of a relief rally, but we went a little bit too far, too fast, as we all saw now with hindsight, right? And if you think about January, I mean, the bond market was up over 4%. Right, you had stocks that were in the high single digits, right? NASDAQ was in the double digits. In fact, even after yesterday, NASDAQ's still kind of flirting with that double-digit return year to date. And so it's been this big reversal of trends. But what has changed in the last 2.5 weeks is really the market's starting to discount the whole idea of the Fed put again, right? And that they're going to pivot and that we're going to have this, reversion back to these levels of lower interest rates. And so the market's been fighting the Fed, right? The Fed has said they're going to be staunch this year. And all of a sudden now with some of the economic data picking back up in January, right? It was pretty abysmal in December. I mean, we saw retail sales come down. You saw the services data come in significantly. And then all of a sudden we get these strong jobs reports. There's a lot of controversy about the adjustments. Now we've seen the inflation narrative again change because of the BLS adjustments, right? So all of a sudden what looked like this glide path that the Fed was achieving, this path back to 2%, all of a sudden with these new revisions, they just add another 100 basis points to CPI. So I think the market is saying all of a sudden they maybe went a little too far, a little bit too fast. But right now, we're really kind of in the rates level we were back in November. And so we're not at the highs. The 2-year actually set a new high in this cycle yesterday. But that's really just pricing in the new Fed path that the Fed is talking about.
And what is that new path? I think up to a couple weeks ago, the prevailing thought in the markets, the Fed would maybe stop 5%, maybe a little bit over. Mm-hmm. Now I'm starting to see commentary, maybe 6%. Is it 7%? I'm not trying to sound outlandish here, but is that what the market is pricing in here? When do you see the Fed stopping?
No, not at all. What the market is pricing is roughly another 2.5 hikes or so. Maybe we get to 3, so call it 75 basis points. That would put us at a 5.5% rate. And the Fed has told you for the last 6 months they're going to 5. Right, the market fought it, right, and so what the dynamic in there, does it really matter if we go to 5.25 or 5.5%? I really don't think so.
Do you see 6%?
I don't see it at this stage, okay. And I think what you have to see is a more persistent inflation, and the challenge is that you have base effects coming in that are going to bring year-over-year comparisons down. But what happened in this last CPI report is all of a sudden it came in hotter month over month than the expectations. And so now there's this new question on whether or not inflation is going to stay contained. But probably the problem is that for all the hikes that we have in the marketplace, they're not really in the economy yet, right? We always hear about these long and variable lags, right? And the Fed, even Chairman Powell's acknowledged them. But if you think about, the setup and usually how the Fed slows things, what do? They're trying to slow down the economy by slowing down growth, right? They're trying to make borrowing more expensive, and they're trying to incentivize saving. Well, if you think about borrowing, corporate America did a lot of it at very low interest rates, right? So unless you had to come to the market, you're not paying prevailing yields, you still have low coupon. Actually, the consumer, when you think about households, right? If you think about mortgage rates, everybody refied because rates were so low for so long. And so what you've seen is that this typical mechanism may not have actually hit the economy at this stage. So I think what this means is that we're probably going to have weakness more in the second half of this year as these things really start to materialize from the Fed's policy. But ultimately, I'm not convinced savers are enticed by this 5% kind of T-bill at this point. And the reason I think that they're not is because of the inflation. And most people in this country, your viewership here, they probably feel that inflation is significantly higher than what we're seeing. And that 5% maybe isn't enough to curtail their spending. So I think that these long and variable lags, which we never know what they look like, I'm afraid that they could be a little bit longer here. And so the Fed should be cautious. They shouldn't just push to 6-7%. I know Bullard was out a few months ago saying 7%. But I think what they need to do is be patient. But the one thing the Fed doesn't want to do is stop hiking and have to restart hiking again.
Well, then that raises, I think, the discussion, is this the Fed that has sown the seeds for a recession in the second half of this year?
I don't know if it's the second half. It's going to definitely become more challenged. It may be a 2024 issue.
So 2024 potential recession.
Yeah, that's
bad
what
recession.
Well, we don't know what a recession looks like right at this stage. But the thing is that there's been this resiliency in labor. You and I were talking before here too. The service side it just continues to really show more job growth, and so we know labor is a lagged variable. We know that it's the last thing to kind of drop when you talk about the economy. But ultimately, what does a recession look like? Right now, where's the weakness? Right? There's a little bit in some parts of the housing market, some of the commercial real estate market, but in general, you're not seeing it in the economic data. And so thus far, it's kind of bucked the trend. But remember, it was extremely pessimistic in the fourth quarter, right? I mean, coming into this year, I think what was it, like 60% of Wall Street, the economists, had a recession in the forecast. In my career, I don't remember seeing like 10% ever saying that. So I think what it is that it's this policy. We're used to the Fed inducing recession. They will likely induce one again, but it's the timing that's really not unknown. But for right now, the economy still looks okay.
As a firm that focuses on bonds, how concerned are you about the debt ceiling debate? How destabilizing do you think that could be in the back half of this year?
I'm not really that concerned about it. And the reason I'm not that concerned about it is because if you plot the total debt outstanding of the government and the debt ceiling, and you go back over the last 40 years or so, those lines are indiscernible. Right? We always just bump to them. The difference is now is Congress feels more contentious than it's been. But what will happen in that area, if we get to the point of where we're talking about a default and you're shutting down the economy, right, and you cause pain to the American population, they're going to complain to their Congress people, right? And that's what will get things done. So I think it's grandstanding at this point. I think the whole McCarthy thing, it was just big grandstanding.
So you are not positioning for a default. You still think the can gets kicked down the road, and that's how it goes.
Yeah, because ultimately we have a printing press, right? We can satisfy our debts if we choose to. If we don't choose to, it's a whole nother issue, right? And then you jeopardize the overall economy as a whole for what? Right, at this point. And so, yes, we're ingrained in this mandatory spending. It needs to change, but the whole idea of the debt ceiling being an issue, it just hasn't been. And like, if you look at the Treasury market, it really isn't priced anything at this point, because we've seen this story before, and it usually plays out that it's 11th hour negotiation. And again, it's grandstanding usually at the end of the day.
DoubleLine has a massive following on the Yahoo Finance platform, Jeff. Everyone is always very keyed into what moves you're making. For this average investor universe that is on our platform, how do they position their portfolios in what might be a volatile few weeks? Yeah,
well, I think right now, hiding in T-bills is not a bad trade, right? That's not talking our book, right? You can go buy them directly from the government, right? You have a government money market fund out there. And so I think it's important to realize that what you were clamoring for 18 months ago was yield. It's everywhere today, right? And we've had a backup in rates. And so at this level, rates look pretty attractive, because we do think that although inflation does remain above Fed target, right? The Fed's targeting 2, we probably get a 4 handle this year in inflation. But that path will slow over time, because all of this Fed-induced hikes will slow things down over time, which will also slow the inflation side down. So ultimately, we think that upgrading quality in the portfolio, which is kind of a cheap thing to say, but what that means is you don't want to be owning as much high yield at this point. Bank loans are causing us a little bit more concern.
Why is that?
Because they float. Mm-hmm. So all the benefits that the investor gets, right, of the floating rate coupon, right, the lender itself actually has a problem, right? Because all of a sudden now you have this company that had all this floating rate debt. Well, now you're paying 5% more in interest. So as an investor, you receive a higher coupon, but the burden goes to that. So those benefits I talked about at corporate America, like in the investment grade bond market or in the high yield market, are actually the antithesis in the floating rate market, right? It's more costly. It can be more problematic. So I think that investors should be cautious of that part of the market today. I still think, again, where we are in the cycle, I think owning some credit is okay. But I don't think you should be out there extending your risk budgets, right? And so what we've been doing, in fact, we've been buying rates on this backup lately. We've extended what we call the duration of the portfolio, the interest rate sensitivity, and we're doing that by buying treasuries. We're not buying T-bills. We're buying longer treasuries out there. And we think that that is the right thing to do at this point in the cycle, because it gives you, if we have that recession risk and it hits us sooner than we think it does, it gives us the chance to make a lot of money on that side, right? And again, if our credit goes down, right, the treasuries can offset that. So for a typical investor right now, I think what you should be doing is really thinking about the fixed income portfolio and what it can offer you. If you're worried about this noise and the choppiness in the next few weeks, look, sit in a money market account for a little bit, but you have to have a plan. When do you buy the market? And having a 10-year treasury above 390, approaching 4%, looks pretty appealing. Remember, Brian, 18 months ago, the high yield bond market didn't yield 4%.
And I know the firm has also pushed into ETFs. Is there a safe way, or how should investors be doing that? How do they play some of these ETFs in a volatile market?
Well, I mean, ETFs are just an investment vehicle. It's just like a mutual fund. It's just another choice. And so the nice thing about the ETF is you have intraday liquidity, unlike a mutual fund. So it allows investors to get in the market at any point during the day. But I think they're just trading vehicles like anything else. You're trying to express a strategy. And so, I've always questioned whether or not, does an investor need to have intraday liquidity on a fixed income portfolio? Because you don't think about that as this massive trading swing. But it has been in the last year or so. And so our push into ETFs is because our investors have asked for it from us. And so it's not something new to us. We have a relationship with State Street under the Spider brand. We've been running ETFs under their platform since 2014. So this is not something new to us. It's just we have it under our umbrella as well. And so it's because of the client demand that we created the products.
Last one for you here, Jeff. Yield curve inversion. Do you view that still as a great recession indicator?
Yes, ultimately. But I don't. But the problem with and why I say ultimately, it doesn't say the recession's imminent. What I glean from the yield curve inversion today is that the bond market is telling the Fed they are too tight. That is what the bond market is saying. So we can argue whether or not it's recessionary or not in the short term, but the bond market is fighting the Fed. It's saying you are too tight with your policy and you are going to have to relent at some point. But the thing is, with this last rate sell-off and yields going up, the entire curve has moved almost, pari passu, or what we call a parallel shift. And so ultimately, I think what you're seeing there is it's the bond market saying the inflation is going to come down. We're seeing that in some of the data. Yes, there was an uptick in 1 month-over-month number, but ultimately the bond market is saying you will not stay there throughout this cycle. And so the Fed is going to stay put. They're going to get to a level this year. They're not likely to cut rates, and the bar for them cutting rates is significantly high. They must fight inflation. Listen to Jay Powell talk every time he has a press conference. That is his number one mission at this point. And so regardless if they have to throw us into a mild recession, that's what they're kind of hoping for. And what's a recession at the end of the day? If we have house prices go down another 5-10%, is that a recession? I don't know. A recession should be broad-based. And so
sounds like it would be an opportunity for me to finally own a home.
Yeah.
Maybe that'd be good.
I mean, there's nothing wrong with that. And so, look, at the end of it, house prices went up, from the nadir of the pandemic to the peak. They went up nationwide almost like 45%, right? And that was like 2 years, right? That's too much, too fast. We overshot. That's like a lot of the economic data. And I think that's what you've seen. It's been a challenging year last year with the economic data as well, because these overshoots to the upside, well, guess what? You get overshoots to the downside as well. And so, again, our recession indicators don't say that it's imminent, but they say you should be on alert. You should start building the position, which is why we're starting to buy more treasuries into our portfolios. It's simply to try to start planning for that. And look, if we're wrong, guess what? All of a sudden, we make 4% on our treasuries. It's not a bad trade.
It's always good to make extra money. Jeff Sherman, DoubleLine Deputy Chief Investment Officer. We will let you get back to picking trades. That's what you do here. Get back to work. We'll talk to you soon.
Thanks, Brian.
Back to you guys in New York.
All right. Thanks so much, Brian. Appreciate it. We'll have much more from Brian Sozzi in Tampa, Florida, as we go on throughout the rest of today.